Good evening. Tonight, we dive deep into a story that raises fundamental questions about property rights, banking practices, and justice in Kenya. It's a story of 60 million shillings paid, 13 years of waiting, and a plot of land that remains just a promise on paper. This is a special investigation into a case that has dragged on since 2013, involving a major financial institution, a frustrated buyer, and a legal system that seems to move at a glacial pace. I'm your host, and over the next 12 minutes, we'll unpack the details, examine the broader context of Kenya's 1.07 trillion shilling SACCO sector, and ask what this case tells us about accountability in our financial system. We'll hear perspectives from legal experts, banking analysts, and consumer advocates. This is Kenya News Update today. Our story begins in 2013. The town of Manyangwa, northeast of Kampala, was beginning its transformation from a rural area into one of Wakiso's fastest-growing commercial corridors. It was here that a man named J. Ruled Ndawula saw an opportunity. At a public auction conducted by Equity Bank Uganda, Ndawula successfully bid 60 million shillings for a foreclosed property. The land was listed as Kaya Dondo Block 178, Plot 604 at Manyangwa Trading Center, along the Gayaza Kalaji Road. The property had been repossessed by the bank from a previous owner. For Ndawula, this was a smart investment in a promising location. He paid the money in full, expecting to receive the title and take possession of his new asset. That was 13 years ago. Today, in February 2026, J. Ruled Ndawula still does not have his land. The 60 million shillings is gone, and the plot remains entangled in a web of legal and administrative delays. This is not just a story about one man and one bank. It's a window into systemic issues that affect countless Kenyans who engage with financial institutions. Let's put that 60 million shillings into perspective. Adjusted for inflation over 13 years, that sum today would be worth approximately 120 million shillings. That's a significant financial loss for any individual. But the cost isn't just monetary. It's 13 years of planning deferred, 13 years of potential development lost, and 13 years of stress and legal battles. We reached out to Equity Bank for comment. In a written statement, the bank said, "This matter is subject to ongoing legal proceedings, and it would be inappropriate to comment on the specifics. Equity Bank remains committed to resolving all customer disputes in accordance with the law." The bank also highlighted its recent corporate social responsibility initiatives, including the training of over 700 new graduate employees across the country, as evidence of its positive role in the community. But for critics, this case represents a stark contrast between public image and private practice. To understand the environment in which this dispute exists, we must look at Kenya's massive SACCO sector. According to the latest data from the SACCO Society's regulatory authority, SASRA, the sector's total assets crossed 1.07 trillion shillings in 2024. That's 1.07 trillion shillings. Deposits alone rose from 682 billion shillings in 2023 to 749 billion shillings in 2024. Membership grew from 6.84 million to 7.39 million Kenyans in that same period. This is a sector that represents the savings and aspirations of millions. And as regulation tightens, with SASRA imposing stricter compliance requirements, smaller SACCOs are feeling the squeeze. This has created an opportunity for mid-tier banks, including Equity, to strengthen ties with these cooperatives, offering them banking services and liquidity management. It's a lucrative market, but one that demands the highest levels of trust and fiduciary responsibility. Now, let's examine the legal concept at the heart of this case, equity. In finance, equity refers to ownership of assets. In law, particularly common law, equity refers to a set of legal principles that supplement strict rules of law where their application would operate harshly. It's the body of law that addresses fairness and justice. The very name of the bank involved, Equity, invokes this principle. So what does Equity demand in a case like J. Ruled Ndawula's? We spoke to senior counsel Miriam Wanjiku, a property law expert. When a bank sells a property at auction, she explained, it makes certain warranties. It warrants that it has the right to sell, that the title is clear, and that it will facilitate the transfer. If after 13 years the transfer has not been completed, there is a fundamental breach. The buyer's remedy isn't just a refund, it's specific performance or substantial damages for the lost opportunity. She pointed out that courts have increasingly been awarding damages based on the current market value of the property, not just the purchase price paid years ago. What has happened during these 13 years? Our investigation traced the court filings. The case has been heard in no fewer than 4 different courts, moving from magistrates' court to the High Court on a question of jurisdiction and facing numerous adjournments. At one point, the original title documents were reported missing from the lands registry, causing a 2-year delay. Another delay was caused by a third party coming forward with a claim to the same land, alleging a prior interest that was not disclosed at the auction. Each of these obstacles required a new legal motion, a new hearing, and more time. For J. Ruled and Dawu Law, the process has been a masterclass in bureaucratic frustration. I have spent more on legal fees than I originally paid for the land, he told us in an interview. Every time we get close, a new problem appears. The bank's lawyers are always there, but they never seem to have the urgency that I have. My money has been held for 13 years. Theirs was received on day 1. This case raises a critical question about the role of banks in property auctions. Banks act as secured creditors. When a borrower defaults, the bank has the right to repossess and sell the collateral to recover its debt. This process is supposed to be efficient and final. But what happens when the bank's own processes or the state of the title it holds are flawed? Who bears the risk? The buyer at auction, like Ndawu Law, assumes they are buying a clean asset. If that turns out to be false, the bank's liability is clear in principle, but elusive in practice. A banking industry insider who spoke on condition of anonymity gave us a different perspective. Auction sales are sold as is, the source said. There is always a caveat emptor, buyer beware element. The bank's primary duty is to its depositors and shareholders to recover the debt. Conducting due diligence on the title's entire history is the buyer's responsibility, often through their lawyer. This is a starkly different view from the principle of fairness implied by the bank's own name. Let's zoom out and look at the scale of the sector where this dispute sits. Kenya's SACCO sector, with its 1.07 trillion shillings in assets, is a pillar of the economy. It's where teachers, farmers, civil servants, and entrepreneurs pool their resources. The tightening of SASRA regulations is a direct response to past failures and a desire to protect these vast savings. The regulations require higher capital adequacy, better governance, and stricter reporting. For smaller SACCOs, the cost of compliance can be prohibitive, leading to consolidation or partnerships with banks. This is where institutions like Equity Bank see opportunity. By providing treasury services, technology platforms, and liquidity support to SACCOs, banks integrate themselves deeply into the financial ecosystem of ordinary Kenyans. This integration brings with it a profound responsibility. When a bank's name is on a SACCO's door, members trust that the bank's practices are beyond reproach. A case like the Manyangwa land dispute chips away at that trust. We can draw a parallel to another story of African legacy and restoration, albeit on a different scale. In Addis Ababa, the historic Africa Hall, a modernist masterpiece completed in 1961, recently underwent a £42 million rebirth. It won the World Monuments Fund/Knoll Modernism Prize after a meticulous restoration. This hall, where the Organization of African Unity was founded, was brought back to its original glory through immense effort and investment. The lesson here is about the value of preserving what is rightfully yours, of investing in a legacy, and of seeing a process through to completion. For J. Ruled Ndawu Law, his 60 million shilling investment was meant to build a legacy, a commercial property in a growing town. Instead, he has been stuck in a 13-year renovation nightmare with no architect and no foreman, only lawyers and delays. What are the potential resolutions? Legally, the court could finally order a mandatory injunction, compelling the bank and the lands registry to complete the transfer, regardless of the administrative hurdles. It could award Ndawu Law the current market value of the land, which could be double or triple his 2013 purchase price. Or, it could order a refund of the 60 million shillings with interest calculated at commercial rates, which would also be a significant sum. But beyond the legal remedy, there is a regulatory question. Should the Central Bank of Kenya or the Banking Fraud Investigation Department take a keener interest in such cases? When a bank's auction process leads to a 13-year dispute, it suggests a failure in the bank's own internal controls and legal vetting. This isn't just a civil matter. It could be viewed as a consumer protection issue of the highest order. As we conclude, let's revisit the numbers that frame this discussion. 1 man, 60 million shillings, 13 years, 0 land. Contrast that with the sector, 1.07 trillion shillings in SACCO assets, 7.39 million members, and a regulatory push for greater transparency. The disconnect is jarring. The The principles of equity and fairness must apply to the smallest transaction as diligently as they do to the largest institution. The training of 700 new bank staff is commendable, but what is the core curriculum? Does it emphasize the finality of a sale, the sanctity of a contract, and the duty to resolve customer issues with speed and integrity? The future of Kenya's financial sector depends on trust. Trust that when you pay for an asset, you receive it. Trust that institutions will do the right thing, not just the legal minimum. The case of J. Ruled and Dawula versus Equity Bank is a test of that trust. It's a story that has dragged on for 13 years. The question for all of us is, how much longer? This has been a Kenya News Update, today's special investigation. Subscribe to Kenya News Update today for more in-depth reporting.